Welcome to the debate. Imagine trying to send an email to a colleague overseas, but at the moment your message crosses the Atlantic, it just shatters into unreadable code simply because the recipient's internet provider doesn't recognize your domestic regulations.
Which sounds absurd today.
Totally absurd. We expect global information to flow seamlessly on neutral, shared infrastructure. Yet that fractured, highly localized reality is exactly how our global financial system currently treats the digital euro.
Right.
This discussion format serves as an accompaniment for the essay LAGARDE'S Cut: Why Europe Cannot Win the Stablecoin Race by Trying to Run It. Usually, when central bankers step up to the podium, you expect carefully measured ambiguity, right? A world of gentle implications.
Exactly. They rarely deal in absolutes.
But on May 8, 2026, European Central Bank President Christine Lagarde broke a massive policy taboo. She stated outright that if Europe wants to strengthen the international appeal of the euro, well, stablecoins are simply not the efficient way to do it.
And when she said that, she conceptually separated the stablecoin as an instrument, the shiny digital token itself, from its function, which is the underlying technological architecture of global settlement. That conceptual cut is just, it's profound.
It really is, and it frames our central disagreement today. Does issuing a heavily regulated euro stablecoin actually strengthen Europe's digital sovereignty? Or does it structurally weaken our economy by trapping us in an unwinnable race against the US dollar?
A race we've arguably already lost.
Well, I will argue that a euro stablecoin, fortified by our MiCA regulatory framework and sovereign European infrastructure like the Pontes network, is an absolutely necessary, pragmatic step to defend our digital sovereignty.
Well, I will argue that building a regulated euro stablecoin offers nothing but the illusion of sovereignty. Europe needs to abandon the token issuance race entirely. The battle for the token has been lost, and our only viable strategy is to integrate into a neutral global settlement layer.
Okay, let's ground this in the stark reality of the market. When you look at the data cited in the essay, the asymmetry is staggering. We are looking at roughly $318 billion circulating globally in dollar-backed stablecoins.
It's massive.
And the euro stablecoin market? A mere $673 million. That isn't just a gap, it's a chasm. But acknowledging that gap doesn't mean Europe should simply surrender to dollar dominance.
So what are the actual options here?
Well, the essay outlines 3 potential paths. The first is surrender, just policing the edges of dollar dominance. The second is actively building a regulated euro stablecoin market. And the third is abandoning the token to focus on the underlying neutral layer.
Right.
I believe we must fiercely pursue the second strategy. Look, we have a massive domestic market of over 450 million citizens. By leveraging MACAR, the Markets in Crypto Assets regulation, we create a legally secure protective moat.
A moat that might just isolate us.
I disagree. Inside that moat, we can provide a credible, pluralistic alternative to the dollar. If we don't issue our own regulated instrument, our digital economy will be entirely hollowed out by foreign tokens.
I mean, that assumes we are still at the starting line of this race, and that a protective moat can somehow reverse the laws of economic gravity. We are not at the start.
We have the regulatory framework now, though.
Sure, but the dollar has undeniably won the issuance war. It represents over 99.5% of the global stablecoin float. Trying to construct a regulated euro stablecoin to compete with that kind of entrenched monopoly isn't a defense strategy. It is, quite literally, a macroeconomic suicide pill.
That's a strong claim.
It is, because it completely ignores how global liquidity actually functions. Stablecoins are network goods. Their utility doesn't come from a government mandate or the logo stamped on the digital coin. I am strictly advocating for the third strategy, adopting the neutral infrastructure underneath the stablecoins.
But abandoning the token entirely?
Yes, Europe's path to true digital sovereignty requires focusing on the architectural plumbing. We need to ensure global trade operates on a neutral layer, rather than wasting our capital building an isolated European walled garden that the rest of the world will simply ignore.
But if you're listening to this and wondering why Europe can't just mandate the use of our own token domestically, we have to look closely at what you're calling an isolated walled garden. Why is it doomed to fail?
Because of liquidity.
How can you look at an economic bloc as powerful as the European Union and conclude that a euro stablecoin entering the market in 2026 is mathematically destined to become nothing more than a glorified, slow-moving digital Giro account?
Well, it's because of the nonlinear network effects of liquidity. Let's explain the mechanics of why people actually hold stablecoins in the first place. A trader or a cross-border merchant, they don't care about European regulatory pride.
They care about cost and speed.
Exactly. Their calculus is based entirely on utility. How many trading venues quote this token, how deep are the market-making order books, and critically, how many decentralized finance or DeFi protocols accept this specific token as premium collateral for loans.
Right, the essay highlights that disparity clearly.
Nick Puckrin distilled this beautifully on the morning of Lagarde's speech. The dollar stablecoin market capitalization is roughly 473 times the euro stablecoin market cap. That isn't a temporary market fluctuation. That is a hardened, self-reinforcing network state.
But markets can shift.
Not when liquidity begets liquidity. If you issue a pristine, fully regulated euro stablecoin today, it starts at the absolute bottom of that nonlinear curve. No global merchant wants to hold a token they can't instantly deploy into deep liquidity pools.
Look, that logic holds if you believe global speculative DeFi trading is the sole metric of success. But doesn't MiCAR act as a necessary protective dam against that offshore Wild West?
A dam implies you're holding something valuable back.
We are. MiCAR imposes strict audit standards and reserve requirements. We built the safest financial environment in the world. Even if the chaotic offshore liquidity flows in dollars, shouldn't we prioritize a sovereign, regulated surface for our own banks, institutions, and citizens?
Plurality for the sake of plurality isn't enough.
But by forcing European exchanges to integrate a euro stablecoin and making it legally compliant, we ensure domestic plurality. We ensure that European businesses have a digital asset natively denominated in their own unit of account.
I mean, you can build the safest, most perfectly regulated harbor on Earth, but if all the global trade ships are sailing across a completely different ocean, your perfect harbor is just an empty museum.
That's a bit hyperbolic.
It's exactly what the essay brilliantly exposes as illusion 1 and illusion 2. You are conflating plurality with sovereignty, and you are vastly overestimating what MiCAR can actually control. MiCAR only governs jurisdictional surface.
Which is essential for domestic stability.
Sure, it dictates the rules for how a token is issued and redeemed strictly within the borders of the EU. But the actual power of a stablecoin like settling a cross-border trade between Asia and Latin America, the dollarization of emerging market savings in Africa, or serving as base collateral in global lending protocols, all of that happens entirely outside of European supervision.
So you're saying regulation is pointless globally?
I'm saying regulation can shape your domestic corner, but it cannot shift the global center of gravity. What you end up with is a token that works perfectly at home, but stops working the precise moment value crosses a border. Having a token-shaped consolation prize that no one outside your borders will touch is not sovereignty.
I disagree that protecting domestic monetary transmission is a mere consolation prize. But let's follow your argument deeper, because this is where your stance against the euro stablecoin gets particularly extreme.
I wouldn't call it extreme, just realistic.
Well, you claim that successfully scaling a regulated euro stablecoin wouldn't just be useless globally, but would act as a macroeconomic suicide pill at home due to what you call the forced buyer trap.
That's right.
If we actually succeed in getting Europeans to use this token, why is capturing the demand for our own debt somehow a lethal threat to the European Central Bank?
Okay, let's break down the mechanics of the forced buyer trap. If Europe somehow defies the odds and successfully scales a massive, regulated euro stablecoin, what backs it?
Safe, liquid reserves, sovereign paper.
By law, yes. The token issuers have to take those billions of euros from users and park them in government bonds, German Bunds, French OATs, Italian BTPs. By succeeding, the stablecoin issuer transforms into a systemic, captive buyer of European sovereign debt.
Exactly, which sounds like a massive strategic benefit. Look at what is happening across the Atlantic right now with the U.S. Genius Act.
That is a completely different macroeconomic environment.
Is it? That piece of legislation essentially mandates that dollar stablecoin issuers buy U.S. treasuries to back their tokens. They have actively turned private crypto companies into structural buyers of their national debt, effectively funding their empire.
Yes, funding their empire being the key phrase.
They have captive buyers suppressing the yield on their debt, keeping their borrowing costs low. Why is it hailed as a geopolitical victory for the United States to capture its own debt demand through stablecoins, but you label it a suicide pill for the European Central Bank to do the exact same thing?
Because you have to look at the drastically different structural realities of their respective central banks. The U.S. can tolerate that trap precisely because it enforces global dollar hegemony and funds an empire that prices global commodities.
But the ECB?
The ECB is in a completely different, much more fragile position. The ECB's balance sheet is already enormously swollen with sovereign debt from years of quantitative easing. If stablecoin issuers become massive structural buyers, yes, they suppress yields in the short term. But let's look at the mechanics of what happens the moment inflation returns.
They raise rates?
To cool the economy, the ECB is forced to raise interest rates. When new interest rates go up, the value of all those older, low-yield bonds sitting in the stablecoin reserves plummets.
Which creates a duration mismatch.
Exactly. If the public gets spooked and suddenly demands to redeem their stablecoins for cash, the issuer has to liquidate those bonds at a massive, forced loss. That is exactly the duration mismatch that triggered the collapse of Silicon Valley Bank.
I see the risk, but
To protect the digital peg and prevent a run, the ECB would be forced to step in. They would lose their freedom to raise rates and set independent monetary policy. You are suggesting we pay for the aesthetic of a digital token by sacrificing the central bank's ability to fight inflation.
But taking a step back to the core function of money, right, the unit of account, even if we acknowledge the balance sheet complexities, isn't pegging a digital token to our own fiat currency fundamentally necessary to protect the stability of European transactions? People need to transact in a unit they understand.
Not when the underlying unit is actively drifting.
Drifting?
The essay refers to this as the broken ruler concept. We treat fiat currencies as static rulers to measure value, but the ruler itself is bending under the weight of the debt it carries. Let's look at the macroeconomic data.
You mean asset inflation?
Right. The Buffett indicator, which measures the total valuation of the stock market against GDP, is sitting at 230%. That metric isn't showing us an organic economic boom. It is measuring a numerator heavily inflated by central bank liquidity provision, while the denominator, actual demographic and productivity growth, is stagnating.
So you're saying the euro itself is broken?
I'm saying pegging a shiny new digital token one-to-one to a drifting fiat unit doesn't magically stabilize the purchasing power of the citizens using it. It merely takes the existing drift of the fiat currency and puts it on faster digital rails.
Fast rails are still an upgrade.
As Lagarde noted, the singleness of money is about whether the unit measures the same exact thing across time. A euro stablecoin makes the euro faster, certainly, but it absolutely does not make the euro a better ruler.
Okay, if the token instrument itself is fundamentally flawed and the unit of account is drifting, as you suggest, then we are forced to move one layer deeper into the technological stack.
To the architecture.
Exactly. We have to examine the underlying architecture, and this is precisely where European innovation is thriving. I want to talk about Pontes.
Ah, Pontes.
The Eurosystem's wholesale DLT settlement layer, which is launching in Q3 2026. This isn't just an abstract theory. In 2024, we saw rigorous wholesale DLT trials. Dozens of European banks successfully tested financial settlement across private EVMs and Corda sandboxes.
Sure, the sandboxes were successful.
For those listening, we are talking about highly secure, enterprise-grade, permissioned blockchain environments where banks can settle transactions instantly. Pontes connects the legacy Target wholesale clearing system directly with this new distributed ledger technology.
It's good engineering, I won't deny that.
It is brilliant internal engineering. It provides exactly the secure, modernized architectural plumbing you are demanding, but it remains governed by accountable European institutions. Think of it as building magnificent, high-speed bridges between the different rooms of our domestic financial house.
I agree that the engineering behind Pontes is impressive, but it is solving the entirely wrong problem. Your own analogy betrays the flaw. Pontes is just domestic piping.
Which we need.
It is exactly like building magnificent bridges between different rooms in the exact same house. Yes, it allows a German bank and a French bank to settle wholesale transactions in tokenized euros beautifully against the target system. But how does that magnificent internal bridge help an Indonesian importer trying to settle a dollar-denominated invoice with a Brazilian exporter?
Well, it doesn't. But facilitating trade between Indonesia and Brazil isn't the mandate of the European Central Bank. Its mandate is to secure the European domestic market and ensure the smooth transmission of our monetary policy.
But the global liquidity that dictates the future of digital finance isn't captured in isolated private walled gardens. This is where the essay's analogy of the Roman aqueducts is so vital to understand.
The aqueducts were imperial infrastructure, though.
But they didn't belong to a single local governor, and they weren't restricted to a single province. They moved water across distinct, highly competitive territories because they were shared, neutral infrastructure. They succeeded because they made side choosing unnecessary.
Neutrality is a strong word here.
Global settlement in the 21st century will happen on infrastructure that does not belong to any of the sovereign territories it crosses. Pontes is necessary domestic plumbing, absolutely, but it is entirely insufficient for achieving global digital sovereignty. Europe desperately needs a window in our outer wall that opens onto a neutral settlement layer that no single jurisdiction owns.
And that brings us directly to what the essay labels the Brussels illusions, specifically this utopian idea that true neutrality actually exists in digital infrastructure.
It's not utopian.
Let's be intellectually honest here. Neutrality in technology is a fiction. Every public blockchain, every supposed neutral settlement layer is operated by validators. Those validators exist in physical sovereign jurisdictions.
Yes, but
The node operators have nationalities. The development foundations are incorporated in specific countries, and usually they're outside of Europe. Why should the European Central Bank or any sovereign entity trust a public, supposedly neutral layer over infrastructure like Pontes that is governed by democratically accountable European entities?
Because you're misunderstanding neutrality.
The moment a real geopolitical crisis hits, that supposed neutrality evaporates when a powerful state actor decides to enforce its will on the physical validator network.
You are treating governance as a binary toggle rather than a spectrum of resilience. Neutrality in this context is not some pure philosophical aesthetic, it is a hard structural property. True neutrality is not the absence of jurisdiction, it is the absence of a single jurisdictional choke point.
Elaborate on that.
Let's look at the mechanics. If you rely solely on Pontes, you have a single issuer and a single regulator. It is highly efficient, but it represents a single point of failure. It can be censored, legally tilted, or weaponized into a political instrument overnight.
By European authorities, yes.
A mature, decentralized public network operates on an entirely different premise. It relies on massive validator diversity. If the validator set is spread across 50 different jurisdictions, if the consensus mechanism doesn't depend on any single regulator's enforcement arm, and if the codebase is open source enough to allow network participants to publish a competing node list if one gets censored, well, it is operationally far more neutral than a centrally owned bank consortium.
I mean, in theory, sure.
Imperfect, structurally distributed neutrality is vastly superior to centralized vulnerability.
But aren't we seeing the dollar architecture already co-opting these public layers? Let's look at RLLUSD, Ripple's dollar stablecoin. The essay specifically describes it as a Trojan horse built inside the architecture.
Ah, the Trojan horse.
Right. Here you have a highly credible, well-resourced U.S. issuer pulling massive transaction volume onto a settlement layer that wasn't designed to be explicitly American. If the United States is already successfully weaponizing the neutral layer to extend dollar dominance, doesn't that validate the absolute necessity for Europe to build and defend our own sovereign walled garden?
no, it proves the exact opposite. It exposes the central beautiful paradox of this entire financial war. The U.S. has indisputably won the issuance race. The dollar dominates the tokens.
Right?
Therefore, the dollar cannot be allowed to also control the architectural layer underneath it, because that underlying layer has to clear transactions for everyone globally. The neutral settlement layer is the final choke point of last resort.
So we just yield the token market entirely?
Whoever runs that layer,
Or more accurately, whoever ensures it is run by no one in particular, controls the only part of the technological stack that the dollar's network effect hasn't captured yet.
Okay, but if the U.S. is deploying Trojans into the public infrastructure, Europe's strategy cannot just be to retreat into the Pontes-walled garden and lock the door.
Exactly. Our mandate must be aggressive adoption, integration, and active governance at the validator level of these global public networks. We must show up to govern the aqueduct. That is the only realistic way you secure sovereignty in a networked world.
Well, that fundamentally abdicates the historical role of the central bank in issuing and protecting the unit of account. If we abandon the issuance of the digital instrument and relegate ourselves to merely being one of many voices governing a global IT infrastructure, we have effectively surrendered monetary policy to technologists and offshore validators.
It's an evolution, not a surrender.
Our domestic plumbing, as you dismissively call it, ensures that European laws apply to European transactions.
But European laws don't dictate global trade flows. That is the critical blind spot in the current institutional consensus. You are trading structural sovereignty for surface optics. You want the comforting aesthetic of sovereignty, a compliant digital token with a euro symbol stamped on it. But it is merely motion without progress.
I think it's tangible protection.
The true battle has moved one layer down. If we spend the next decade admiring our own beautifully engineered internal plumbing, while the rest of the world standardizes on a globally trusted neutral ledger, we will die of thirst.
Look, it is a profound tension, and it strikes at the heart of what money will be in the coming century. Let me summarize where we stand as we draw this debate to a close.
Sure.
I maintain that a European instrument, a MiCAR-compliant euro-stablecoin, coupled with highly secure domestic infrastructure like Pontes, is an essential foundational step. We cannot govern the globe, but we can and must protect the euro system from being entirely hollowed out by foreign dollar-denominated tokens. Plurality and regulatory moats have tangible, real-world value for protecting our domestic monetary transmission.
And I maintain that the true battle is architectural, not narrative. The only way to secure the singleness of money on a global scale is by recognizing that the issuance war is over. We must show up to govern the neutral aqueducts. The currency itself can stay European, but the settlement infrastructure must become shared. Emitting yet another compliant peg is simply the comfortable answer to the wrong question.
What is genuinely fascinating about this specific debate is that it isn't purely theoretical. The essay lays out strict falsifiability markers. We won't have to guess who is right. We will know by watching the data over the next few years.
That's the best part of this.
If a regulated euro stablecoin manages to reach a sustained share above 5% of the global stablecoin float by the fourth quarter of 2027, without relying on artificial regulatory subsidies to prop it up, then the network effect asymmetry is much more closable than your architectural thesis assumes.
Exactly. And conversely, if the ECB issues a formal opinion explicitly endorsing a euro stablecoin issuer mandate by Q2 2027, then Lagarde's framing on May 8th was just a transitional rhetorical position, not the profound structural cut I am arguing it was. The thesis is highly testable, and the market will provide the verdict.
It is without a doubt the defining monetary question of the decade. Do we build isolated, highly regulated fortresses to protect our own currency? Or do we step outside the walls to help govern the global infrastructure that everyone relies on? When you look closely at the diagnostic X-ray of our global financial system, the clean lines blur. We are forced to decide whether we are going to keep staring at the broken ruler or finally start examining the pipes. Thanks for listening and more deep dives. JaniceTheWatcher.substack.com.